I guess the moral of the story might be is like, don't suck ass for 30 years because you think you should own the property that long.
Totally. What's going on, guys? Welcome to this episode of the Collecting Keys Real Estate Investing Podcast. Today is the Mike and Dan Show, where I, Mike DeHaan, and my co-host here, Dan Austin, talk about real estate investing, business, and whatever is on Dan's mind, which always seems to be something completely random.
So random. No, I was trying to say before you so rudely interrupted me at this podcast that I think I would become a hat guy. I'm like, get a hat like the Sub 2 hat, but I need a hat.
Well, we need like a, you could get like a Collecting Keys hat, but we both have stuff for that in the background, so we need like different. So we need a Don't Be a Square Peg hat.
That'd be a cool hat, actually.
Yeah, I think so. Actually, we just have like the little Square Peg logo. My wife has that all designed. I just need to like give her the final write-off on it, and we can get it up on the store. But we have some other good ones that are showing up there.
I need to add to my shirt collection.
Yeah, I know. We needed the full Collecting Keys line, which you can get at store.collectingkeyspodcast.com.
I'm wearing a personal shirt right now, a Gonzaga Bulldogs shirt, which I don't care about, so I need something a little more spicy.
Well, I'm pretty sure every shirt that you wear is something that you got for free from somewhere. But
actually, I paid for this. Come on, Gonzaga doesn't give anything away for free.
Nah, dude, your wife's grandma probably gave it to you. As like,
maybe.
You went there. Yeah. So.
God rest her soul.
Yeah. Anyways, real estate. We have some drama going on in the rental property world. So typically on this show, we talk a lot about our wholesaling business. We talk about, our mastermind community where other people are doing wholesaling, they're flipping houses and all sort of stuff. And occasionally we talk about our rental properties, which we have accumulated over the past number of years. But as we have just been trying to scale towards more massive income, which makes passive income just less enticing. I mean, why would I care about $500 a month in passive income when I can instead make $50,000 a month from wholesaling properties, if I'm being completely honest, especially because I'm not a bum who wants to sit on the beach and I actually like to kind of do stuff and make money. It just draws your attention. But we still do have a bunch of rental properties, and I'm very excited because you said that we have some great news, or not great. We have some kind of news to discuss on the show today.
Yeah,
so
I
we
didn't
can
say
have
drama
a
or anything
meeting.
like that. It's what I would call just another day in the world of being a landlord. I feel like it's funny because we haven't bought a lot of properties recently because of what you just said. But I feel like now this year we've had the most amount of just wild ass stories that happen. And you're like, how did that happen? How did we get through buying properties with meth head tenants and evicting them and going through all this sort of stuff, not come across crazy situations like we do this year?
Well, I think because we bought most of our stuff in 2020, I guess. So we bought a bunch of stuff ourselves, 2008, 2019. We joined up 2020, started buying a bunch of things 2020, 2021. And I think we only bought a couple properties last year because the market kind of turned over. So I think we're probably starting to see the effects of tenant turnover and different things because people don't stay in properties forever.
Mark kind of thing.
Yeah, that 3 to 5 year mark where things start happening with properties. Things start turning over. The parts of real estate that I have cash flow and I don't have to do anything, people never tell you about while they're taking pictures on the beach and they're just I have all these properties. I don't think about it. Yeah, they do. They just lie and say that it doesn't actually happen, but they do all the time.
Yeah, that's actually a good point because you talk about cash flow and what most people, if you are working with a seasoned investor, not somebody that's, buying thousands of apartments, that's a whole different thing. But somebody that's buying, smaller multifamilies, 6, 10, 20 units and predominantly single families and duplexes, they usually have a number of cash flow net. And what we mean by net is legitimately after you've paid for expenses and put enough set asides to round out the year because you might have the fridge in July, so you got to save up X amount per month, right? So net would be after all of that of $150 to $250 a door. That's probably the range, $250 being on the high side for most investors. Now we have units that cash flow vastly higher than that, right? If we're going to go out looking for stuff, that's on the radar of okay, $250 a door is not bad. And then You throw on what is your cash on cash, because if 250 a door means your cash on cash is like 6%, get out of here with that shit. Your cash on cash at 250 a door should probably be like, at 250 a door, you'd probably be at like 12 to 15% is where you'd want to be. Like
Ideally,
ideally, if you're getting less than that, you're putting a lot of, depending on how much money you're putting out there. Again, if that's $100 that it costs you to get 12 to 15%, like who gives a shit, right? Like there's a scale of like what you're risking. So if you're getting 12 to 15% on like 50K, 100K, like that's a good return. But if you're getting less than that, then go somewhere else, because honestly, you can invest in a business and make vastly more money, or you can just go put it in the stock market or another much more passive investment than landlording. Because even if you have property managers, landlording is not passive, it's an active business. Like the more and more we do this and the more and more we own, just the more and more I call it active. Like on my goal sheet for GoBundance, I should just switch all of that income to active.
Yeah. I mean, honestly, you should. Like your horizontal income to vertical income. I mean, and, there are other benefits to real estate, though, right?
Tons
like not just the cash flow, like you have the appreciation. You can use leverage to buy these assets. You get tax benefits, all that sort of stuff. I mean, which is honestly the reason that we've been able to, become successful, is because our properties have grown in value so much. But we also hit the boat before stuff went crazy. And we were beneficiaries of that, right? Because we were taking action back before anyone knew that was going to happen. And I'll say, ultimately, you just need to look at what your real estate goals are. And if you have a long-term time horizon, you can look at those other things besides cash flow. If you want to be, doing well, right now, you probably need to build on some more active income stuff. And you can't just, expect it to come from passive cash flow, because that takes a very long time to build, because the capital is needed. And also, too, the way that the business works, you will always have these unexpected expenses that come up, regardless of what people tell you, regardless of where they say, oh, you just get a good property manager, you all things. That's all nonsense. Honestly, we have done this so many times, talked to so many people, and every actual operator that we know that isn't just like an Instagram person will tell you that's all horseshit.
Yeah, it's a true business, and you have to run it as such so that you can protect your investment. I guess to pivot a little bit before we come back full circle on this, I like to think about it when I'm playing with house money. So when I first started, when we came together, most of my money contributed to the company was from rental property cash flow, right? So I was reinvesting that money, and I was basically playing with house money at that point, right? So I'm not losing. I mean, if I lost money, I'm losing money, right? But it's not actually coming out of my savings account, so to speak. And so when you get into this, a lot of people like to do what we started out doing, which is start an off-market business, because you can wholesale and you can flip. And now, if you have a profitable wholesaling and flipping business, if you're doing it correctly, you can use that money, the house money, to invest in your long-term rental properties, which eventually, if you do this well enough, you're going to need that, because you're going to want another vehicle for investing that's going to have appreciation and cash flow built in. But also, the depreciation is a great thing to be able to offset some of those high profits you get from flipping and wholesaling.
Yeah. Well, and that's such an important piece too, is that is how you really accelerate that, right? Is having that active income to be able to buy those properties, or learning how to buy the properties at a discount, so that you can actually do the BRRRR method and recycle that money. And a lot of people miss that because they don't want to do the dirty work. It sounds like too much work. So instead, they go look at these 10, 15, 20-year time horizons, which is fine. But it's when you have people that want to, retire from their job, you want to have financial freedom in a 2-year time span, you're not going to find that without doing that heavy lifting to generate that large income to be able to invest right now. Literally, the only reason we've been able, what are we on, 50 whatever doors between two of us? I mean, there's a couple that we own separately. We were able to do that in a couple of years because we had that huge amount of income that was coming in that we could just dump into properties over and over and over again. And because we were buying at a discount, we didn't have to lock up that money. And that's not possible if you are just kind of going the traditional method of looking on the MLS, saving for your next house, collecting your 15% cash flow.
Yep. You can't do much scale. Scale is the name of the game in real estate.
Yeah, absolutely.
It really is.
So, yeah. So what's going on with our stuff? I have no idea, because you handle that kind of our business, so I'm honestly...
Oh, yeah. So I was on my way to record this, and one of the guys at our property management company called me on our 6th unit in East Spokane here.
Nice. In the hood, to be fair. It's pretty rough.
I actually like that very short strip. It's not bad.
And it is a nice property for the area. It's way better than the 7 unit that we flipped three blocks down that
blocks
was
down,
a
yeah.
hellhole.
That's a different part of East Spokane. Anyways, so yeah, we go in there, or he calls me. He's like, yeah, so we got a bed bug problem, which I've never had to deal with bed bugs. I do know it's an extreme situation, and it's not easy to deal with. And so we have a tenant there in one of the units, crusty old guy. He smokes in the unit. Like, he's an inherited tenant that we've had. He's been on month-to-month lease since basically we took it, or we bought it, took it over. Anyways, so yeah, the property manager calls and he's like, yeah, so just want you to let you know we have bed bugs in so-and-so's unit, and we looked at the other units. It hasn't spread, so we know it's him. Like, he's the cause. And I was like, okay, cool. And so it's $1,100 to get rid of the bed bugs. This is the pest control company's been out there. I'm assuming that's like $1,100 to treat it. Doesn't necessarily mean it's going to go away. And we can bill that to the tenant because I guess dirty tenants cause bed bugs. Like, I don't know how you get bed bugs. Like, I've never had them, but apparently by being dirty, somehow you breed them, or maybe you bring them. Maybe it's like fleas. Like, you bring an animal in, animal has fleas, you get them. I have no idea. Don't know anything about bed bugs. We're not like a very buggy part of the world in Eastern Washington. Like, not a lot of bugs around here. Mm-hmm. So anyways, we got that. The funniest part about this is he was kind of like hemming and hawing. He's like, yeah, so I don't know what you want to do, like maybe evict him. I was like, yeah, get rid of him. I was like, I don't want him in there anymore. He's dirty. He's brought bed bugs to the building. He's been smoking in the unit, which he wasn't supposed to be doing anyway, so the unit's dirty. I was like, we're already turning another unit, so we're going to be on site with a blueprint of how to turn that unit. So I was like, get rid of this guy. And he's like, okay, good. And I was like, yeah, man, like I'm down to clown. Like, let's go.
Yeah. Well, it's such a funny thing, right? Because the property managers are like that because most landlords, right, they are small time, and they are kind of like the scenario we were talking about before, of where they don't have any sort of large form of income. They are typical income earners, right, who have invested in properties over the years. So for them to like put in the investment to turn a unit is like a really big deal.
Yeah.
You know?
Right. And it's not an easy decision to make, but in the long term, when you think about it, bad tenant bringing bed bugs is going to disrupt the other tenants. He's probably not great for the property. We're already turning another unit, so I'm hoping to get a nicer, higher-end rent for that and a nicer, cleaner tenant. If we can do two at the same time, and next thing you know, you start turning it, and then you change the whole dynamic of the building, and that is the long-term play you want.
Yeah, and that's being a professional investor versus, you know, kind of like a mom and pop, right? Is having that long-term vision, understanding that. And to be fair, a lot of the people that go the other way, I mean, a lot of people that are in the other position, they wouldn't update it. They'd be like, oh, he's paying rent, like he's Section 8, it's fine, leave it alone.
Yeah, we just raised his rent too, which is funny, and he's going to pay, so he was paying rent.
Yeah, so I mean, like, there's the whole thing there, and most people would just leave it, and then sure enough, they go 2, 3, 4, 5 years down the track, they start to have problems, they decide they want to exit. No one will buy the property because it's terrible, and they call us, and then we buy it for 60 cents on the dollar, which is honestly how we bought this property too.
Exactly how we bought it.
You know, it was an old guy who had these tenants that he had neglected for 20 years. The place had a bunch of like random things. He was a really weird, old, kind of crusty dude and was very uncomfortable with the type of people that were in the property, and so we bought it from him at a screaming deal. I think we bought it for like $600. It appraised as we closed for $775, and once we get things at market rent, this thing should be worth $1 million.
Yeah, it will be conservatively in this market, especially where we're going to go with the prices. So it's going to be pretty sweet. And yeah, it's one of those situations where like we took this thing over, and we've had tenants in there. We haven't actually had any units turn, and because a lot of them were Section 8. We were waiting to raise the rents because you can only raise rents once a year with Section 8 housing, at least with our Spokane Housing Authority. I don't know that nationwide is a fact, but anyways, the whole situation, like with our old property manager who we bought it and put under property management, really delayed this because they screwed up kind of the process of rent increases and actually signing new leases because they're all on month to month. Well, here's the challenge for all of our Washington State listeners. If you're month to month, you have to give people 120-day notice to move out. So we got Bedbug Boy for another 120 days. His rent's going up in September 1st, and then so we have to wait. Basically, so what is it? October 8th. So 120 days does not end 120 days from today. It ends from September 1st, right? Because the way they make it line up is it's got to be before the first of the month that you have to issue it. So that is a tough thing for Washington State. landlords to deal
Yeah.
with it. That was a change, was it last year that went into effect? And the whole month, which now is why most landlords here in the state, if you're tactical, you do not let your leases go month to month. You actually just make it so that they're, I can't remember what you call, like tenant in sufferance or tenant in whatever,
Yeah.
where they basically have to leave after 12 months if you don't sign a new lease.
See, and this goes exactly to what we were talking about before, about how it can never be truly passive, because we literally bought it. We had a property management company who is owned by one of the big dick investors in town and has a very good reputation. His property management company is absolute garbage.
Trash.
Like the worst company in town, because it's like one lady who's inept, but they sure talk a big game. They have like a whole
Yeah.
presentation about how they're going to do it. And then, so they had this situation, right, where we bought this house probably like a year ago, and now we're finally dealing with it because they failed to do what they needed to do right out the gates. And that's not even talking about the other shit that she sucked at. Like I had some single family homes that I was in the process of turning, that I had tenants move out. She was supposed to lease up, and it took her 2 months to lease them up. Oh, it actually took her 2 months, and they weren't leased up. And then finally I was frustrated, so I just went and posted pictures myself on Facebook and had them leased up in 2 days, because I don't know what the fuck she was doing, right? But the thing is, like, you can't even necessarily verify that, because this is a company that is literally owned by one of the top companies, like top groups in town, and has apparently a lot of units that they do, like that they manage, right? So I'm like, what is this situation? And that's where the work comes in. If you're trying to make it passive, is you now have to manage the manager.
Yep, that's your job.
And even that's your job, right? And even with what you're doing right now, there's a situation, the management still needs to talk to you about it and help you strategize what exactly you want that to look like.
Right. And you're playing telephone, right? Because now you're getting filtered information from the property manager, which you're hoping that they're doing a good job. But if you're having to manage a situation like this, you have to assume that the property manager is conveying the accurate information to you, or the most accurate information, and that they're saying the same thing to the tenants that you want them to. And rarely does that happen. It seems like when the situations are a little complicated or complex, it takes vastly longer than you would hope, because of that third person that's in the middle of you and the tenants. So the conversations just kind of get out of hand.
Yeah, they do all the time. And just like for weird things, right? Because they're humans that are involved at every part. But like many years ago, I had a different property manager who was managing my units, and it's like an older female. She was actually pretty organized and okay at what she did. But the problem was, there was this certain archetype of tenant, which are basically women that were the same age, and they would always just freaking butt heads to the point that like it would cause problems, because I had tenants that would sort of like fit that MO, and they wouldn't, like, the property manager wouldn't talk to them, and they wouldn't talk to the property manager, and they would always just like talk shit on each other. And I was like, you want to know what's really trashy? When a property manager calls you to talk shit on the tenant that you have in your property. Like, who does that?
Right. Yeah, that's stupid.
But like, it was just like a nonstop thing, and I was like, what is this? Anyway, fired her too. But it's part of the gig. Okay, so we're getting that one leased up at Christmas with a higher rent. What else we have going on?
That's actually like the only terrible thing. We still have units that we're trying to lease that have been for lease for a month and a half, but like, that also speaks to. So we had two units come available about the same time, and one is actually leased. They're going to move in mid-month, so that's good. The other one I'm actually waiting to hear back. And this actually is a good point to discuss, because I was reading some news articles about this as well. Like, rents have peaked. We're kind of at the top, and I think last year in Spokane, probably this time is when we hit the peak. Probably, and we were fortunate because we locked in rents, like really high rates on some of our buildings. That we were like, Jesus, I can't believe we got that. Okay, sweet. And now trying to get the same rent a year later is just not happening. Like, it is kind of, but the people are less qualified. It's actually tougher out there to get tenants in some of these buildings at the same or slightly below rent. So I think for many markets, we're going to start seeing some backsliding on rents. So don't think that because you have a duplex in that same neighborhood that rented last year for $1,500 a side that you're going to get $1,550 or even $1,500 a side this year.
Yeah, I mean, I think that's a really valid comment.
Or be open to being vacant for a month while you wait.
Yeah,
and is that worth $50?
Exactly. I mean, and that's a big thing is a lot of people don't account for those numbers, especially if they started in real estate between 2020 and now, because they're used to being able to rent stuff out very, very quickly.
Yep.
But back when we started 2018, 2019, that was kind of the golden rule was you expected to have at least 1 month of vacancy every single year at like a minimum.
Yep.
Right. So you included that into your numbers.
Well, there's no way you can turn a unit any faster because if you think about it this way, because a lot of times it's easy habit to just come up with a percentage number of like, okay, percentage of rent. Well, percentage of your rent is 2 weeks that you're accounting for vacancy. Like likely you're not. I mean, I don't know that you could turn a unit in 2 weeks. If the market's super hot, you can. Like there's some times last year where we could. But if you think about getting the tenant out of there, making any needed repairs, getting the thing cleaned, getting it listed for lease. If you're like trying to do all that stuff before they actually move out, you can get ahead of the game. You can do that, but then you're also looking for people that can move mid-month, which is most people's leases are up. And the challenge with tenants becomes they seem to be more mobile. They seem to be more active in trying to move up in life or move lateral or do stuff because it seems like nowadays, the last few years anyways, a lot of our tenants have been 12 to 24 months. Very few, unless we inherited them, are like, yeah, I'm going to be here forever. Like we have one dude out in one of our duplexes, like, I don't know that guy will ever leave. And like we've raised his rent and we've never had to rehab his unit. He's like the perfect inherited tenant.
Yeah. I mean, and he even said, he's like, I'll pay whatever you want, just don't make me move.
Yeah. Exactly. So, all right, cool.
Yeah. So, no, it is interesting. After a while, it starts to get to this point where it's like, especially since our stuff is appreciated so much, there's a few things you track with rental properties, right? Obviously, you have your cash and cash return, which is huge, but you also have the return on equity, which starts to become a thing to consider, especially if you own properties that have appreciated in value a significant amount. Because you can have a good cash on cash return, but eventually that return on equity starts to get lower and lower and lower. And I look at some of these properties that I own that I make, $400 a month on. But then like my actual equity that's in there, if I sold it, I could walk away with like 180 grand.
Yeah.
So so it gets to a point where it's like, is it really worth keeping? Especially with where we're at in the market, where I don't see the market going ham again anytime soon. Like what I personally think is that the market's going to be relatively flat for a very long time. Like we might have some, little fluctuations here and there. But I think that with just the way interest rates are, the way that like the affordability situation in the United States is looking, that properties are not going to increase in value a large amount. So I'm like, should I keep rolling with it or should I look to sell out at this point?
Well, so I did the math for you. If you took $180,000 net and you put it in the hard money business making 12%, you would make 5 times as much money. No, 4 times, sorry. A little over 4 times as much money in extra passive income. And then you could roll 2/3 of that back into it so it continues to appreciate and still get the cash flow.
There you go. And see, and that's the thing is I can compound that too,
Yep.
right? With our hard money business or with funds, with different things like that. And, with no real downside risk. It's not like I don't have to worry about a roof causing an issue or a like refrigerator going out and things like that.
The interesting thing about this actually just popped in my head. When you run an off-market real estate business like we do, like many of our listeners do or want to do, when you have the ability to market to and buy discounted properties, selling a property and repositioning that money is less of a risk to you long-term than if you had to wait to buy that deal till a wholesaler brought it to you or until you could afford to house hack it or however MLS deals, right? If you're just like popping them off, slim pickings, kind of like we were before we started this business, where like, man, selling a property that you got a good deal on, that would suck because you're like, I don't know when the next time I'm getting a good deal. But you could take this 180 grand, drop into an LP investment, which can be and is pretty dang passive, right? Other than managing and making sure you're getting your money and your return. Like you can drop that in there. Heck, another one pops up that's at 65 cents on the dollar. Buy that one, run that one up with equity the same exact way as you did this one. 3 or 4 years later, sell that one too and put it in LP. And ultimately, you can have a bunch more passive income, but still have all the shots at goal to keep buying properties anyways.
Yeah. I mean, and I think that that's what real passive income wealth looks like from like a sophisticated financial standpoint, right? Like in my mind, I think that the old sort of bigger pockets adage of like, accumulate this big rental portfolio, work to pay them down and all sort of stuff so you can make X amount of money. That's probably, I think that that's a good long-term way to kind of do it. If you want to go the traditional route of like trying to buy off the MLS or buying from wholesalers, those sort of things. If you want to have it immediately, buying these discounted properties, getting involved in them, holding them for like a short period of time, creating that value. And that's a big thing too that we've done with a lot of our portfolios. We've been finishing basements, increasing rents, increasing square footage, doing major updates, doing those things, holding them for like 1 or 2 years, and then selling for very large gains and rolling those into truly passive investments such as like debt funds or syndications or those sort of things. That's how you make like true real estate passive wealth. You can do the hard work to accumulate a single family portfolio that way over a couple of years. We've only been doing this for, I guess, coming up on 4 years now, but I could sell all of our properties. If I sold all of them and I sold all of my own stuff, I'd have like $2.5 million in cash. I could go and I could put that into a debt fund that pays me 9%. I have a pretty reasonable lifestyle. I would not have to work again.
Yeah.
Like at all. It's like, and I don't have to ever worry about a roof or some other bullshit. It just like is going to always make more than I spend unless I have some sort of crazy big increase in life expense, but I don't expect to do that because I already do everything that I want to do.
Yeah, that's the power of real estate right there.
Exactly. Yeah.
But I guess the moral of the story might be is like, don't suck ass for 30 years because you think you should own the property that long.
Totally.
You know what I mean?
Yeah.
Like, get in and get out as needed, as it makes sense when you're looking at your KPIs around return on investment, return on equity, cash on cash, whatever you want to call them. Once you feel comfortable with that, be okay with selling that property, trading up, and being okay actively searching for more. Like, if you keep buying properties at a discount, you're always going to have upside on them, right? Like, unless you buy it at a discount and then like it burns down, you don't have insurance on it or whatever, As long as you hold the property for a reasonable amount of time, there's always going to be upside. So if you can buy a property at 65 cents on the dollar, appreciate it to where you need to, get it stabilized, and then sell it when it makes sense, which is probably 3, 5, or 7 years. I would say somewhere in that realm. Roll that into something else that's more passive so you can keep working on your active things. If you want to pop off a flip, make 30, 40 grand, boom, there you go. Add 30, 40 grand to your income.
Yeah.
Pop off a couple wholesales a month, boom, you made another 30, 40 grand.
Yeah. And I think that kind of the counterpoint to that, right, what people will say is because it's an investment. So I guess in my situation, if sold, $2.5 million, that's what I would have. If I held on to it for a long period of time, as of right now, it's worth, I don't know, $10.5 million, about right, like the full portfolio altogether. So it's like saying you're giving up that $10.5 million now for the $10.5 million in the future for $2 million now. And I guess if you have a really long time horizon, people would say that was foolish. But at the same time, I think that's still something for like people that don't have a lot of upside with themselves or like their businesses or those other sort of things, right? Because like from my viewpoint, if it allows me to not have to worry about any money right now and I can instead just like go full on into our business and like making that as large as possible without having to take a paycheck or things like that from it, that seems like a no-brainer to me because I imagine that my total payout in 30 years, at least my hope is that over the next 30 years, I will make significantly more than $10 million or the $8 million difference, whatever that is, right?
But here's the one caveat that I was actually thinking about this the other day is that, so that 10 million, that total debt or whatever, so say it's 7.5 million, that debt pay down, because some people actually calculate debt pay down as part of their return, which you should. It is a benefit, right? We talk about leverage being awesome. But that 7.5 million pay down can actually shrink down to 4 to 5 to 3 to whatever, depending on where the market's at when you want to de-lever yourself.
That's true.
You know what I mean? And so on a long time horizon, which many of our notes are, if you're not getting commercial loans, like if you're getting the 30-year notes, like on a long time horizon, that doesn't matter, right? Because it's always going to go up. But it's not maybe going to go up at the exact straight line that you think it is. It just depends on where you're at in the market when you sell it and you de-lever, what that looks like.
Yeah.
So, something to think about. I know we're talking like anti-real estate on some of this stuff, but I think it's just the mantra that we have, which is like look at upgrading your real estate portfolio when the time's right.
Well, I don't think it's an anti-real estate. It's a pro-opportunity cost.
Boom. There you go.
Right? Which is if you want to be a business owner and you want to make like real money, understanding opportunity cost is extremely important.
Yeah, it's
you know, and it's so important not to have like a sunk cost bias in these properties that you're attached to because you work so hard to get them. You know, you have this cheap debt. You know, it's an A-class property, A-class area. If you have better uses for that money, or you have ambitions to have better uses for that money, you just need to make sure that you do a, you know, internal look at yourself and a deep dive into your finances and your goals and see if it actually does align with that or not.
Right. So here's a data point for you. If you took your $2.5 million, stuck it in a 9% fund, like you said, like a debt fund that just let it roll over and compound, in 10 years you'd have $6 million.
There you go. That's like more than the properties are worth, right? Like
that's more than they'd probably appreciate if you think about it in a 10-year period. Because if you think about 3 to 4% compound appreciation, probably in like a good 10-year period, like if you started this year, the first few years probably aren't going to look so good. You know, in the latter, 6 or 7, it might look more realistic to that 3 to 4%. But here you're going to get likely with a debt fund a guaranteed 9% return, compounded over 10 years, $2.5 million to 6. That's pretty good. Yeah. And that's pretty passive.
It's very passive, right?
It's passive as it gets.
Even split that across some other things, or like, say you take 50 a year and you put it in syndications or other things that have like a 2x multiplier. Yeah. It can go even faster than that. And that's the way that people with big money that are professional investors look at things. Right. So, cool. Well, anyway, it's not anti-real estate. It is just like,
pro opportunity, like you said.
Pro opportunity. You really make sure that you aren't just buying into the same stuff that everyone else says, and you do understand kind of the big picture and what exactly you want to do.
Yeah, I would add to that, like a lot of us and a lot of the listeners probably grew up in like what I would call like Bigger Pockets University. I think I started listening to Bigger Pockets back in 2014 probably. Yeah. And learned, and it was awesome. It still is like a great, product for a lot of people. But if you started listening to it any time in the last 4 or 5 years, you're probably graduated beyond that. And it's like, and if that's going, and a lot of the stuff that they taught back then, those people have graduated from it. That's why those hosts are no longer there, right? And so the host and many people that worked at the company have graduated from that kind of Burr model, where it's just strictly build, and hold this thing for a lifetime. And now everybody is realizing, okay, that is awesome. Build, sell, build, sell, and just you keep building and compounding, but it has to get more and more passive. Otherwise, you're just, I don't know, you're going to turn into the landlords we buy houses from.
Mm-hmm. Yeah, that's exactly right. And that's ultimately, if you don't respect the downside risk possibility, that is absolutely what will happen. Yeah. So, cool. All right, anything else, Dan?
No, that's it.
That's pretty good.
If you guys know anything about bed bugs, hit us up, because I would love to know like what's the success rate of like, and like how do you even get them?
We should talk to our friends down in like the southern states. I feel like we have people in Texas, and we have some of our instant investor members who are in Atlanta and like St. Louis and these places. They seem to see that all the time. Or fleas. They always get fleas there. Yeah, we don't have any of that here.
Yeah, no.
We have like wasps. But they're outside the house. So I don't really care about that.
Yeah, and that's funny. They don't ever try to get inside the house. Now that I think about it.
Imagine, that's like the worst case scenario. Imagine you buy a unit that has an internal wasp infestation.
Ooh, that would be pretty shitty.
Fucking nightmare.
Wear like a bee suit.
Yeah. No, thank you. So, anyways, guys, that's our views on real estate as a whole. And as one last thought, every time you see someone on Instagram, especially if it's like some like young couple that's like 27 that talks about how they just live off their rental income and all shit, they're fucking lying to you. They either don't actually have that, they have daddy's credit card, or they're not telling you the whole truth, right? That's the reality of it. Or they make all of their money selling you like digital products or courses or whatever. Yeah. So just journals. Journals. It's big freaking red flag, because it's every A-class operator we know does not.
We're gonna start selling the instant investor, or the collecting keys affirmation journal here soon.
Oh my god, I just hate that.
And it's gonna have you know what it's gonna just be? It's just gonna be quotes from Mike on like how he hates this stuff. Like, here's your affirmation day. Write this 10,000 times.
Yeah, right. Yeah, it's gonna have you say Pace Morby is full of shit, and you just have to write that 10,000 times.
Those are your affirmations.
Yeah, right. Oh, Jamil is a crook. You just have to write that. Let's say you're in school and you had to like write lines on the whiteboard. But anyways, guys, let us know your thoughts on this. I would love to hear any contrarian opinions you can hit me up on Instagram at Mike_invest, or you can hit up Dan at InvestormanDan. Seriously, this is the kind of stuff that I love to have conversations with people about, because I know we are typically outside the norm from what the general population thinks. So if you think we're stupid, you should go ahead and shoot me a DM. Or if you agree too, you should also send me a DM, because I love to chat with you. So anyways, guys, hit us up there. Besides that, you can go to collectingkeyspodcast.com/free. Get your free 5-step guide to start buying these discounted properties. So then in a couple years, you can also be having a situation of, should I keep getting cash flow, or should I collect my $2.5 million? Great place to be. I highly recommend you start taking some actions to get there. And besides that, everybody, I appreciate y'all listening, and we'll talk to y'all next week.
See y'all.